Welcome everybody this evening. Using options for consistent returns. My name is Don Kaufman. You are watching a TheoTrade presentation. This is a risk disclosure because we are not financial advisors nor a broker-dealer. Why do we really throw this up here? Well, I don't want any confusion. I spent the previous 15 years of my life in the brokerage world. I also like saying no soliciting, no recording, no photography, don't feed the monkeys. Copyright disclaimer, this is ours, this is not yours. You have to have the express written consent of the National Football League, apparently to rebroadcast this. Couple of people from Atlanta. Anybody going to the game? Is anybody actually going to the game? The other thing I throw up here is our email address. If you ever need to get a hold of me, okay, after this evening, just hit us at support@theotrade.com. I always like to make this comment. We answer emails, okay? I answer emails, dozens and dozens and dozens, and we get hundreds of emails every single day, and we answer them. And it's important to us. We use a common inbox, okay? That email, all you have to do is put in the header, send to Don Kaufman, and I will get it. Again, we're located here in the North Scottsdale area. A little bit about me. Again, my name is Don Kaufman. I've been in and around trading, well, pretty much my entire life. I kind of grew up around traders in the family. We started trading in Chicago in the 1970s. I actually graduated college and joined them in the late 90s, about a 21-year trading career. About 2 years after I started trading, I was invited to what became a startup brokerage firm at the time. And that firm was actually called thinkorswim. So I built and then ran the education division of thinkorswim, going back to literally the inception of thinkorswim. Was there when we, of course, took the company public in 2007. I was there for the acquisition by TD Ameritrade in 2009. I remained at TD Ameritrade, and I ran all education for TD Ameritrade. And at the time, there's 7 million clients, up until early 2015, where we ultimately departed. I say we. Several of us here at TheoTrade worked together at TD Ameritrade, and we exited to, of course, build none other than, well, TheoTrade. So we've done a couple of CNBC tours over the years. This is, again, one of the more memorable ones. By the way, the reason I threw this one in here tonight, was discussion of Apple. All right, if you're going to be pitted against somebody, that's the guy you want to be pitted against. Although I have to tell you, it's kind of a big disappointment. He's a really, really nice guy in discussions prior to the interview here. Here's a little bit about TheoTrade. We specialize in education for stocks, options, futures. Okay, we're founded by professional traders, trading educators. Everybody on the crew here has a minimum of 15 years trade experience. Several of us have, again, many, many decades. And one thing you're going to learn, right up front tonight, we are here to help you mitigate the risks in the marketplace while learning a skill set. It's going to take you a lifetime, you'll feel like master, but it's a skill set that'll actually last you a lifetime. The other aspect I really like to bring to everybody's attention right up front, okay, is that TheoTrade, this is not a one-trick pony. This is not one individual at TheoTrade, okay? This is just the instructor crew. Of course, including myself. I'll introduce you to a couple TheoTrade instructors. Jeff Bierman, as I said, many of us left from TD Ameritrade. Well, Jeff Bierman worked side by side both at thinkorswim and TD Ameritrade with me. Analyst, trader, and former chief market technician for TD Ameritrade. That's a highly coveted position. What that basically means, if you've ever been on the thinkorswim software, this is the guy that actually designed most of the studies that are on the thinkorswim software. Again, spectacular grab for us here at TheoTrade. Next, Matt Williamson, market neutral, premium selling strategist. We have very finite specialists in a particular genre of trading. In this case, Matt, market neutral, he sells premium. Corey Rosenblum, his specialty, okay, swing trader, and he's our senior kind of intraday strategist. Next, we have Brandon Chapman. Brandon also worked side by side with me. He's a CMT, macroeconomics, technicals, and fundamentals. As I said, Brandon actually worked with me again at TD Ameritrade, and he actually wrote most of the books that we used for TD Ameritrade and most of the education. It was also a wonderful grab for us. Next is Steve, better known as Slim Miller, 43-year veteran. I've known Slim pretty much my entire trading career. Slim actually started trading in the early 70s, right when options were first listed, literally in 1973. Last but definitely not least, Tony Rago. He's our Nasdaq futures. He's our intraday futures specialist. Okay, at TheoTrade here. So I like, again, to kind of give a little bit of an introduction. We currently have 7 full-time traders and strategists, all focusing on a different genre of trading that we bring you here every single day at TheoTrade. Next, what you're going to learn in this presentation, right? That's it's tonight. Okay, what are you going to learn? So, well, how you can build a trade that's successful over many occurrences. It's something I talk about extensively. I don't care if something works once. You know what? You could probably step out and hit a golf ball once. It went absolutely perfect. Okay, but that's, it's a one-hit wonder. We actually have to get through that. We have to actually talk about the number of large occurrences. That is, if you continue to trade, you have to keep hitting singles and doubles consistently. Okay, how you can take minimal risk and produce consistent returns over here in excess of actually a 55%. And I'll show you that, surrounding really high probability. Okay, there's actually going to be a very high probability of hitting that 55% return for any stock, maybe an ETF or index. In fact, I'm going to show you trades that are in stocks. I'm going to show you some trades that are in ETFs and indices this evening. How you can take high probability directional positions. Okay, whether you're a long-term investor, swing trader, or intraday trader, proper risk reward to grow a small account. By the way, I now currently trade in my retirement account. I will discuss a bit about retirement accounts. Everything I'm going to do this evening is completely applicable to, of course, your IRA or a large account, and how you can trade without necessarily continually monitoring positions. This is going to be a set and forget strategy that we're going to talk about specifically. Now, before I go any further, okay, I like to always challenge people. You're willing to put forth a little bit of effort. So this evening, and this is okay if you're brand new and you've never had any experience whatsoever trading. Anybody? Seriously, it's okay to come out, and say, all right, I've never had any experience whatsoever trading. Is anybody here brand new? Come on, all right? There's, over 1,000 people logged on. Just one person said me. Come on, people. Admitting it's the first step, all right? A couple of people now are coming in. I'm still paper trading. Good, all right? The following course material tonight, it can be a little bit demanding to learn. This is not going to be, what I call follow the bouncing ball chart pattern. I'm not into that. I am a quantitative, strategist. That means if I can't put numerical value behind it, if I can't prove that over 100 or over 1,000 times, if you do this trade over 1,000 times, are you going to make money in that trade? If I can't, show proof in the pudding, then I would step back from it. If you really want to learn this business, you're going to need to be willing to put forth some effort. Everybody wants instant coffee, instant tea. They're, what do you mean? You mean I don't turn it on as a piece of software and it makes me money? Okay. Listen, I've been in this business too long to deal with that kind of garbage. I just have. This is a skill set. It's based on statistical data. What we're about to discuss, it involves trade logic. I'll explain what that means. It involves strategy. And it involves probabilities in trading. And I hope that that's all right with everybody, okay? Because you need those aspects to have a degree of success in this business, okay? Or you will fall and fail miserably. First place to start, it's actually one of my favorite slides. I use this in a lot of different slide decks because it's often, I would say, the most overlooked aspect of success in this business. It's risk and success. How you handle your risk is directly correlated to your success in the markets. Too much risk, and you're going to panic. And you're going to close positions continuously at the worst possible time. But hey, at least you're consistent with your panic. And you have to appreciate this. So he's, by the way, this is indicative of throwing up your position. If you've never heard that term, it's called puking your position. Hey, but at least he's a Mac user, right? Apple earnings out after the bell. So the reason I throw this, to you, I know right off the bat that one of the primary reasons that people take big hits in this business, the position moves against you. You either get stopped out, you take some heat, and all of a sudden, yada, 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 the market turns around. You got out at the worst possible moment. Anybody? Has anybody ever been in that position? Okay. And it's okay to answer this because again, I do read the chats, and if you're listening to this on a recording, I don't care, yell at the computer screen, right? People constantly do the same things again and again and again and again. Now, it's people always say whenever I talk about this stuff, they're like, it's like you can look at my account, or like you have looked at my account. I have looked at your account. What I've learned, I spent 15 years in the brokerage industry. I've looked at hundreds of thousands of accounts. People always ask, like, how could you look at 100,000 plus accounts? We studied them. We had an entire group at TD Ameritrade. We lovingly called them as a group. It was statisticians, actuaries, types. We actually called them the nerdery. Kid you not, they actually called them the nerdery. And we used to actually study what accounts do. We've seen what works and what doesn't. What doesn't, it just gets repeated over and over and over again. I can tell you exactly where people fail, where they make money. Today, we're actually going to discuss what's worked consistently. Consistency is absolutely the key, and that's why I threw this little picture down over here, because again, I have literally looked at hundreds of thousands of active trader accounts. In fact, I've actually data mined a larger account base than any other firm, because TD Ameritrade at the time had the largest base of active traders of any retail firm. You name a strategy, we can actually give you details behind that. Now, again, we're going to discuss precisely what has worked and its consistency. We start with theory, trade, and logic. Okay, people always ask what TheoTrade means. That's what it means. That's what TheoTrade means. It means theory, trade, logic. That's what TheoTrade came from. We start with probabilities or law in the markets. One trade, good or bad, does not define you as a trader. Remember that. It's never going to be about one idea or one trade. And people do this all the time. They're like, if it hadn't been for that Apple trade that I took a hit on, you can't put that much risk. Trading goes beyond one trade or one idea. It's about hundreds or even thousands of occurrences. And that sounds like thousands of occurrences. It sounds like a lot. But listen, if you're going to be involved in this business, and you're going to be involved in this business for a few years, you'll literally do thousands of different occurrences. And you have to have the right logic over time. Like, listen, this business, it's hard enough. You can't mess this up. You can't mess up the trade logic. You can't change your strategy every other day. Somebody goes to a webinar, they're like, I like it. Then all of a sudden they go to another one, they go, I like it, and they literally like, bright, shiny objects that you're chasing constantly. Listen, this is a lifelong skill you're learning. No one learns it overnight. Go easy on yourself. Let's get into specifically what, again, this theory, trade, logic kind of means. Principles of building a trade. Before I walk you directly into strategy, right? You have to understand trade logic, capital allocation, directional bias. You're like, what? What does that mean? Well, let's get to it. Trade logic. Place strategy and trade logic first. The vast majority of people involved in the markets are infatuated with market direction, attempting to predict the next move. I mean, if you turn on like CNBC, that's all they're doing. What do you think Apple is going to do? Oh, I don't know. Maybe it goes up. Maybe it goes down. I don't know. Maybe you should flip a coin, because I'm going to tell you right now, that ain't going to make you money in the long run. There are lots of firms that are dead wrong about direction, because you're going to find out it's about strategy. The right strategy coupled with established entry and exit criteria. You don't necessarily need to be right in picking direction in a stock or the markets in order to be profitable. I will show you specifically that tonight, because I stress, as I said, I'm a much more quantitative trader. You got to show proofs in the pudding. There's got to be trade logic behind it. And if there's not, that doesn't work for me. The next thing you got to focus on, by the way, so when I'm going into this principles of building a trade, you literally go through like a little checklist. You go, trade logic, do you have it? Capital allocation, directional bias. This is how we approach the entire marketplace. So you have to have the right strategy and trade logic first. Then you come to capital allocation. How and where you allocate capital should be strongly considered as a viable portion of your trading methodology. You know what's funny about capital allocation? It takes precedence over being right in the markets. You're like, what? What are you talking about? If you over-allocate yourself, what does that mean? I put too much money in the market. Guess what? then the market goes against you. So what happens to you? I panic, okay? I flip out, and I end up taking a loss because I couldn't handle the risk in the first place. So don't tell me that directional bias means everything, because a lot of you guys are right. You've been right directionally. You just couldn't hold a position long enough. Huh? Anybody? Come on, again, admit it, admit it, admit it. It's the first step that you must take in your trading. Last but not least, directional bias. Now, I'm not an anti-chartite. That's what I call myself, an anti-chartite. I'm really not anti-charts, but I just recognize where you think a stock might go doesn't always mean the markets are going to agree with your sentiments. I mean, do you realize what's going on this week? This week is like absolutely unequivocally the best week to talk about directional bias because, I don't know, you had Apple earnings tonight. That's a big one. Don't worry, you have Amazon and Microsoft coming on Thursday, but forget about that. You've got China, you've got Brexit, okay, trade wars to deal with and Brexit, and then, did I forget the FOMC tomorrow? I mean, are we having fun yet? Okay, duration over direction. How and where you allocate capital can define not only losses, but it can actually be the defining factor in your overall success or failure. Our war cry has always been duration over direction. By the way, I didn't come up with duration over direction, right? That's actually a war cry that's been used, on trading floors for decades and decades. Basically means you need to be capable of sustaining trades long enough to be profitable. I mean, listen, do you want to be right or do you want to be happy? I love that one. I had to use this because my wife does frequently reminds me of that famous phrase. Do you want to be right or you want to be happy? I have definitely not applied that to my marriage. I've been married just about 10 years over there. But the logic works beautifully in trading. I always take the stance. You don't necessarily have to be right, okay, in essence, to be able to make money. Why? Why, because experience in watching order flow for decades has taught us invaluable lessons. Let's start with this. Have you ever been stopped out of a trade? Okay, and we've already kind of, prompted this a little bit earlier, but have you ever been stopped out of a trade or bailed out of a position only to see the markets turn around shortly thereafter? And everybody's like, yeah, that was me. And we've kind of gone through that a little bit, okay? So what we're going to do, first and foremost, all right, is we're going to talk about core strategy and trade logic. Again, I always hone into core strategy and trade logic because, as I said, this business is hard enough. You can't mess this up. Today, I want to introduce you just to one, just real world strategy. I will show you some of my own positions, okay? You can start using this tomorrow. And it's about the big, aversion to risk, okay? But before we go detailed into the strategy, our focus has to be, and again, you're like, well, why do we talk about core strategy and trade logic, okay? Because a lot of it has to do with risk versus reward. And I want to remind everybody of this. When you first learn about markets and you're first learning about trading, we're often exposed, okay, to the ideas of risk versus reward, right? Okay. So a lot of people, when they very first go out and they learn about trading, what do? Okay. You go out there and you're thinking like, risk one, okay, to do what? To make two. Sound reasonable? Risk one to be able to make two. It's common strategic entrance to the marketplace. Yes? Anybody? However, have you ever looked at the probability of success in this idea? So we're actually going to run this. As I said, everything to me comes down to something that would be what we term quantitative, which is we have to look definitively at the number. How many people have ever done a risk one to be able to make two strategy? Okay. Let's throw that out there to the masses. Okay. Because as you watch, by the way, it doesn't matter whether it's an intraday strategy. Doesn't matter when he went out and did this for a month, for 2 months, for 6 years. I don't care. I want to know, okay, what you do. I want to know what you do, okay, in terms of strategy. Let's debunk risk versus reward. Let's take the following example, right? So we're going to walk you through a little bit of example. We're going to go out, we're going to buy a stock. We're going to buy a stock. We're going to buy it right at 30. So let's just talk about buying a stock. I don't care. By the way, tonight, you could have a $2,000 account or more. Okay, and I'll show you a strategy you could do with $2,000 or more. By the way, you can have a $2 million account and still pull these strategies off as well. So I trade in an IRA, but I also trade in what's termed a portfolio margin account. A portfolio margin account, okay, we've got lots of ample, margin in there. So we're going to buy a stock at 30. We're going to set a stop order at 29. So how much can I lose in here? Oh, if I'm wrong, I can lose $1, right? And we're going to set a target price of 32, which basically means if the stock rallies up, what am I going to make? Okay, 2. So what am I doing? I'm risking 1 to be able to make 2. Prototypical risk 1 to be able to make 2 scenario. Everybody with me? You with me? Because this is where it gets fun. All right. Now, this is where we're going to get involved. Okay? So we're going to get involved and everybody's going to answer questions. There's a whole lot of people in the room tonight. I want to make sure you're listening. Probabilities in your trading. What is more likely? I'm not going to go into detailed probabilities just yet, but I want to know what's a higher probability. Now, put whatever you think aside. And you go, what does that mean, Don? Okay, what, you don't like what I think? I just said put what you think aside. In a normal volatility fluctuation, which is just on a day-to-day basis, normal volatility stocks fluctuate up and down. What do you think the probability of hitting the stop order, is prior to hitting the target price? What I'm saying is, what's likely to happen first? The stock going down $1 or the stock going up 2? Okay. What's more likely to occur? Okay. And this is the one where, people are like, I don't know. I don't know. I can give you an exact answer. Okay. First of all, the probability of hitting the stop order is considerably higher than hitting the target price. That should bother you right off the bat because you're much more likely to get stopped out. And if you get stopped out, it's over, baby. It's over. Because if you get stopped out, literally, it's over. That exits you from the position. So before I go any further, this is what we talk about. Options are probabilities. Now, I know you may have never looked at or ever even traded an options market. However, are you aware that options and option markets are based on probabilities? Okay, so let's say that you're never going to trade an option. Some people come in here and they're like, I'm never, ever, ever going to trade an option. That's fine. But you can use the options market, to help you determine, and help you determine, again, that viability and practicality of any given trading strategy. How, you might ask? Well, let us look at what the probabilities are in the aforementioned risk 1 to make 2 trading setup and see if this is viable over the duration. You ready? Because this is where we go from, we've been in Disneyland. Now we're actually going into like something a little bit more serious. Okay. So what you're looking at right now, it's a screenshot. Now this is a screenshot taken today. And I specifically used Starbucks because Starbucks was trading right smack. It couldn't have been any better. It was on, look at that. I got a screenshot at 67. I actually sat there and I'm like, wait for it. Boom, got a screenshot at 67. What we have over here is termed probability of touching. Okay, what's probability of touching? It's the probability anytime, and I'll just give you an example, anytime, and in this case I picked 17 days from now. So what this says is in the next 17 days. By the way, I could have picked 10 days, 3 days. I picked 17 days because it was, a month maybe a little bit too long, 3 days a little bit too short. But I picked Starbucks because Starbucks has already been through earnings. So in the next 17 days, I wanted to see what's the probability of touching. What's the probability of touching? It's called an anytime probability. Okay. What's the probability of touching, for example, 66, versus 69? What I'm actually implying here, is that you have gone out and you've bought a stock. Now, let me just blank the slate over here, change the color, just so everybody can see this. All right. So what I'm implying is you go out, and you buy the stock and you buy it for $67. Then you set a what? Stop. Careful, because stop, it's a 4-letter word. You set a stop right at 66. So how much can you lose in here? Well, you buy the stock at 67, you set the stop at 66, right? And then your what? Target price, we'll call this the target, is set at what price? 69. Okay, so it's set at 69, which is what? Make 2. This is a prototypical risk one to be able to make 2. Look at the probabilities of what we term touching. It's about a 75% chance of touching the 66 level. Conversely, there's about a 38% probability of touching the 69 level. And I want to know, and people, this is where a lot of people that go, but it depends on the Fibonacci. It depends on the relative this. It depends on that. It depends on what the MACD is doing. No, it does not. Because I'm going to tell you something about the marketplace. If you do hundreds of occurrences over a vast period of time, nothing matters, okay, but the numbers. Okay, and that is, it's not like really up for debate because, again, if you say these numbers, people go, are these numbers right? Well, if they're wrong, the entire market's wrong, okay? If the entire market's wrong, I don't want to be right. And think about that for a second. Even if you think the numbers are wrong, you have to realize the probability of touching the stop order is still going to be considerably higher than touching your target price. That's the part that people don't get. Look at this, the risk versus reward. The aforementioned Starbucks example, the probability of hitting your stop order is 75%. If anybody ever walked into you and said, hey, I want to get you into a strategy, you're going to have a 75% chance of losing money. That's what this is saying. And again, probability of touching, this is a layup. By the way, you may not have like, this is a thinkorswim trading application. If you don't have it, that's fine. I can show you how to do this on any trading application. Okay, any trading application has probability of touching. You just don't know it. Okay, the probability of hitting a stop, and you go, oh, you have a 75% chance of losing a buck. So, well, what's the chance of me making money? 38%. You're like, oh yeah, sign me up for that one. It's a low probability disaster. By the way, this is also true if you did this intraday. So I wanted to debunk that. Now let's get into what will work and what will work consistently. Even if you argue with the, I don't like the 75% and a stop order here, there's a better way to do this. There's a much better way to do this. Positioning your portfolio with the right trade logic. So let's just get down and dirty. How do you position yourself most effectively without exposing yourself to drastic risks and or a low probability? Would you be interested in a trading strategy that, number one, overcomes the high probability of being stopped out? How about we go into a strategy that you can't be stopped out of, right? You're like, what? How is that possible? Okay, we have a strategy you can't be stopped out, right? Because we're not going to use a stop. How about that? It'll define your risk. You'll know exactly what your risk is, provides a high probability of success, limits the capital exposure. That's kind of the same as defining your risk, right? Oh, and you never need to buy or sell the stock. Oh, now we're getting interesting. Okay, enter the in-out spread. In-outs, okay? And if you've ever heard of an in-out, fantastic, because you're going to learn a lot more tonight than you've ever learned before about the in-out. I've had people that have listened to the in-out spread. By the way, in-out spread, this is bread and butter, okay? Bread and butter, especially of a marketplace like we're in right now. In-out spreads are designed to limit exposure and maximize potential with minimal movement in the underlying, okay? Yes, the in-out spreads are option trades. Oh, that's the second time tonight I said the O word. Some people get really, really scared when I mention options. Give us a little time, though. You can learn. This is the basics of options that you need behind this, okay? But I'm going to take you through that tonight. Fear not the options, as options spreads allow us to limit risks without the use of stop orders while providing considerable upside potential. Okay, you ready? In-out spreads explained. Now when I say we're going to get kind of down and dirty, let's do it. Let's do it. So I'm going to give you a few examples. What's a good example? First of all, I'm going to draw this in here. This curve represents a stock, but in my examples, I call every stock stock, okay? And we're going to make this a $50 stock. Stock is trading at 50. Now, I am not going to go out and buy the stock. I'm not going to go out and buy the stock. Why am I not going to go out and buy the stock? Because if I buy the stock, I may have to do something crazy like set a stop order. If I buy the stock, I'm going to have to tie up $50 per share. Even in a margin account, what are you going to have to do? You're going to have to tie up half that. Okay, listen, I know every in, out, end, whatever you want to call it, in the business. I spent 15 years on the brokerage side of it. Now, educating people about things like margin. There's no easy way to say this, but buying stock has, a hell of a lot of risk. So rather than buying stock, we're going to use, okay, what's termed an in-out spread. What does that kind of come down to? Well, we're going to go out and I'm going to make this easy. Okay, we're initially going to buy, okay, what we're going to term a 49 call. Now, 49 call, like what? First of all, what is it going to cost? The 49 call is going to be purchased, and I'm going to make this, the math is easy as I possibly can. Okay, we're going to make this cost $1.50. You with me? Okay, so you're going to 49 call. Okay, for those of you that have no idea what a 49 call is, 49 call gives you the right to buy the stock where? 49. So you could buy the stock at 49. Do you want to buy the stock at 49? No. So why do you buy the 49 call? Because I want the stock to go, let's say, up. So let's initially do what we term, okay, a bullish strategy. Now, people immediately go, but how do you know the stock is going to go up? Don't you worry about that. What did I tell you a moment ago? I told you strategy and logic has to come first. Yes, this is a bullish, but that's very, it's tertiary. It's not even secondary, it's tertiary. It's down the road. Let's not worry about being bullish just yet. But for this example, yes, let's be bullish. So I buy a 49 call, it gives me the right to buy the stock at 49. If I buy a 49 call, again, where do I want the stock to go? Up. Because if the stock goes up, and let's say the stock went to, I don't know, something crazy, like, 60. You have the right to buy the stock at 49. The rest of the world has to pay what? 60 for it. What do you think a 49 call is worth when the stock is trading all the way up here at 60? What's it worth? Okay? It's got to be worth at least what? Well, 49 up to 60, it's worth $11. It's worth $11. Could be even worth a little bit more than that. But, okay, that's not far enough. I don't want to just buy a call. I'll tell you why. Buying a call, okay, could be a huge mistake because you have $1.50 at risk. And if the stock stays flat, okay, you're going to lose part of that $1.50. And if the stock goes down, you're going to lose the full $1.50. Okay? And it's still, again, it kind of leaves you open-ended. So what we're going to do is we're simultaneously going to buy a 49 call, okay? And then we're going to turn around, okay? And we're going to sell a 51 call against it. What are we going to sell the 51 call for? Okay? In this case, let's just make it so easy. Okay? We're going to sell the 51 call for 50 cents. Now, we're going to sell 50 cents. Now we're getting somewhere. So let's take this down below. We're going to buy a 49 call. Okay? And we're going to pay for it. We literally pay $1.50 for it. Simultaneously, we're going to sell, okay, a 51 call. And when you sell something, you collect, in this case, 50 cents. Okay? Net, what do you have? Well, you paid $1.50, you collected 50 cents, so what are you into this thing for? $1. And this is $1, what we call debit. Now stop right there. Okay? Because a lot's going on this screen right now. Put down the pen. Okay? Stop right there. First of all, how did I sell something? I never even owned it. You're like, what are you doing? Okay. Well, I'm buying an option that's actually considered in the money, and I'm selling an option that's considered out of the money. That's why they call it an in-out. One strike in the money, one strike out of the money. One strike in the money, one strike out of the money. Why? And how, again, do I sell something that I never owned? Okay. Because you're selling yourself into an obligation. Here, I have the right to buy the stock at 49. If you have the right to buy the stock at 49, let me ask you something. If you have the right to buy the stock at 49, can you buy the stock at 49? Yes, that's what a right means. But if you sell the 51 call, what does that do? It obligates you. See, buying options have rights. Sellers of options have obligations. Sell the 51 call, you're obligated to give somebody the stock at 51. What's the most you can make on a $2 wide spread? You can only make $2 on here. You're like, I don't like it. Why? Because you only make $2? Right? $2. You could do better than that. I could show you that, but we have to go through the initial example. And here, okay, you're just going to pay $1 for it. You're just going to pay $1 for it. Now, if the stock were to run, okay, from 50 all the way up to even 70, what's the most you can make? Well, you have the right to buy the stock at 49, okay? Somebody can take the stock from you at 51. What do you make? You make $2. You make $2, of which you paid $1 up front. So what do you make? $1. You make $1. Now, again, stop right there. Are you at risk? Listen, nobody, okay, wants to necessarily, when you do, trades and options, nobody really wants to buy stock from you. Nobody even wants to force you to take stock at 51. You just have to understand, okay, that options, people buy and sell options to turn around and sell options. They have no intent of ever owning the stock because you could do this trade with a $2,000 account. Now, I want to bring something to your example, to this example that you've never thought of or maybe haven't seen before. Okay, how is this trade a high probability trade? That's what I want to know. Like, why is this a good trade? And you got to be able to answer that question to make this worthwhile. And I'm going to show you right now. You see, here's one of the keys to the trade. Stock's trading at 50. Where can a stock go? Okay, and let's say that this entire trade here. Let's put this on a time frame. Okay, of 1 month. You guys okay with that? It's 1 month. You paid $1 for a month. For what to happen? Well, I need the stock to go to 51. But what can happen in a month? Let's say you put the trade on tomorrow. Okay, the stock goes down. Where's the stock go down? Stock goes all the way down to 47. What do? You're like, oh man, I'm getting killed. Did you get stopped out? No, because I don't need a stop order. Why? Because I know what my risk is. It's $1. Okay, I can stare $1 in the face and laugh. So the stock goes down to 47. Okay, it even trickles all the way down to 46. Guess what? That happened this week. Next thing you know, the stock takes back off to the upside, tags above 51. What do? Profitability. So when you look at this trade, people look at it initially, they're like, oh yeah, that's got about a 50-50 shot. No, it doesn't have a 50-50 shot. Okay, it would be a pure 50-50 shot. Okay, but again, what's the probability, again, of touching up here? You don't necessarily need to bail out of the strategy earlier. That's one of the points you have to understand in this. You have a dollar debit. What does the dollar debit give you? Okay, it gives you the right to play chicken with the market for the next month. And it's of critical importance over here. And that's why people get like, well, what if I'm bullish? Okay, if you want to be bullish, be bullish. Okay, do you have to necessarily be right over here? No. The other thing is people get beaten up in options when they talk about implied volatility and this and that because I'm buying an option in the money and selling an option out of the money. It negates all the things that beat people up in options. It's one of the purest trades out there. Think about that. The stock can tank. What strategy do you have where the stock can tank, turn back around, come back up, okay, and all of a sudden you're profitable? If the stock tanks, okay, I'm going to lose $1. Are you comfortable with losing $1? You should be. Again, position size it correctly, and you should be. You'd be fine. You'd be just fine. Let's move on. I know, we're getting deep. In-out spread, Starbucks example. Let's continue our original Starbucks example. However, use an in-out spread rather than the stock and stop orders. Rather than buying the stock at 67, we're going to use a spread trade to limit risks and provide a high probability without the use of stops. Ooh, Frappuccino. Okay, here's a Starbucks example. Does this look familiar? Because I just laid it out for you like a minute ago, except I used a fictitious stock called stock. This is Starbucks. Starbucks is trading at 67. I'm going to buy a 66 call. I'm going to sell a 68 call. Look, how wide's that spread? Okay, it's a $2 wide spread, right? It's a $2 wide spread. What's the most you can make in a $2 wide spread? You can make $2, of which you paid $1 up front. So what are you doing in here? Risk $1, okay, to be able to make $1. To risk $1 to be able to make $1. You go, I don't like the risk reward. Why? Because you have such a high probability of making that $1 before taking the full $1 hit. Why? Because what can the stock do? The stock can absolutely go down and then it could rally back up. It could do a little dance, make a little love, get down tonight. There's a lot that can happen, okay, in this particular time frame. Maybe we should take you into a real trade, okay? Because here it is. This is the trade laid out on a trading application, live and uncut. I like to use real examples because I think that, if the proof ain't in the pudding, what's it worth? Okay, nothing. All I'm going to do is go out. I'm going to buy a 66. Okay, I'm going to sell what? A 68 against it. So I'm buying one, selling the other. Got it? Okay. The maximum risk in here is $1. You can see things like probability of touching. Right? Look at the probability of touching. It's right there. Probability of touching. And again, that's to make the full value upwards of like 65% probability in here. That's the kind of strategies that people have to learn. And you never had to substantiate risk beyond what? $1. Right? Now, did I do this one with 17 days left? I did. Okay. Do I have to use 17 days? No. Allow me, okay, to throw, because this is the questions. Like everybody in here is like going to like, should I use the at the money? Should I use this? Oh, you have to use, let me get to this very clearly. You have to use the exact options that we tell you to use. You have to go precisely to this strike, to this delta, okay? Strike in the money, out of the money sounds really easy, but again, there are extraordinarily finite criteria. How far out in time do I go? Okay. How about, here's a fun one. You guys ready for this one? I put this trade on today. Okay. Apple earnings in out spread. So there are people that are probably joining us this evening. Okay. There are people that are joining us this evening that inevitably are trading Apple. All right. What is Apple and why am I mentioning Apple tonight? Well, because Apple had earnings tonight. Did I know that when I took this screenshot? Clearly, I knew there were earnings. I didn't know where the stock was going to go. So I decided to deploy the in-out spread. By the way, this is my account. That means I have an actual position on in the account. Why? Because I actually have the 155, 160 trade. In fact, if anybody watches the evening videos that we do that are out on YouTube, you will know, okay, that I talked about this specific trade on Monday. And I talked about using an in-out spread, and I talked about being bullish in Apple. By the way, after hours, Apple is trading 164. Is this trade going to make me money tomorrow? I paid $2.45, okay, for a $5 wide spread. Now, this one's not a $2 wide spread. This is a $5 wide spread. And a $5 wide spread, you can make $5, of which I paid $2.45 up front. What is this one? Home run! As long as the stock opens up anywhere near that 164, I'm golden. Absolutely golden on this one. Okay, you were like, people immediately go, well, where were you last night? I told you the strategy last night. Okay, I just didn't give everybody like, all the finite details behind it. But we literally, teed this one up in last night's video. In fact, I talked about this extensively throughout the course of today. Here's another one, a high probability in-out spread. Now, I'm bringing this up because this is one of the most feared and yet revered products in the entire industry. This is the SPX. This is a $2,640 product. What's my max risk? Okay, $2.15. Do you realize if you go out and you do one contract of this, look at that. It's one contract. One contract. How much risk do I have? $215. You're like, you mean I can't lose more than $215? Nope. By the way, there is no stock in the SPX. It's an options only product. But here's an interesting one. This isn't a bullish strategy. This is not Starbucks, which is, a $67 stock. This isn't Apple, which is a $164 stock and being bullish. This is the SPX. This is the behemoth, okay? This is the mother of all trades. I can go out 31 days from now, and I can pull off, again, what's called a $5 wide spread for never amounting to more than $215 at risk. I never have a threat of being put stock. And you're like, how can that possibly be? Okay? How can I not be put stock? Because there is no stock. This is a cash settlement product. I'm telling you, this is the kind of stuff you have got to learn. And I know people right now, they're looking at these trades and they're fixated. They're like, but the probability of this is better and that's better. Okay? Don't worry about some of the nuances. Okay? All the mathematics, we do that for you. With that in mind, I'm going to show you a couple trades from my account. This is the live in-out trade examples. Because the questions that I continually get when it comes to in-out, spreads and it comes to trades is like, how would this perform in the extreme volatility that we saw back in December? I don't know. Didn't get much more extreme than this day, right? Okay. Here's a spread that I went out, okay, and I purchased. And I'm actually going to show you specifics, okay? That's the exact date and time that I put the strategy on. This is the exact date and time that I took the trade off. These are, okay, trades that I just took screenshots directly from my account. All of these trades were also done live in front of TheoTrade clientele. I paid 98 cents for this. I closed it for $1.40. Okay. The reason I'm actually covering the in-out spread strategy tonight is because it'll reduce the volatility exposure, reduces your risk infinitely in the midst of heavy, heavy volatility. And I just can't stress that enough. So this is one strategy. Again, so what? We paid 98 cents. We closed it for $1.40. Good. Let's move on. Okay. Next one is X. What's X? It's U.S. Steel. It's an in-out spread. Another live example, right? Here's the irony of this one. Again, I tried to pick one of the most volatile days. The most volatile day that I pretty much could come up with. We'll come back to that in a second. But by the way, I also wanted to show you Intel. So we're all clear. Intel's a bearish strategy. It's got puts. It's puts. It's a bearish strategy. Okay. The next one, this is U.S. Steel. U.S. Steel. This happened to be what? This is calls. This is a bullish strategy. Paid 99 cents, closed it for $1.44. Right? Okay. And you're like, why $1.44? Again, lots of little nuances of this trade. The trade was only on for a few days, which is kind of unusual. Works very, very fast in the midst of, again, some of the heaviest volatility we've seen in any of the recent years. So that's U.S. Steel. Next one, McDonald's. You know why I picked McDonald's? Because this is actually a fairly low volatility kind of underlying. Now this one was a put spread. It was a $5 wide put spread, a $5 wide put spread. Paid 206, sold it for 269. I didn't do that well in this strategy. I did not do that well, but look at the days that I put this on. Literally, one day I put it on, the very next day I took it off. Okay, you're going to hold a position overnight. What would you rather do? Go out and buy or sell McDonald's for $185, or would you rather actually, use a spread that you can't possibly lose more than $2 on? By the way, want another fun one? Okay, here's another one on McDonald's. So I just wanted to show you some fun with numbers. So one day I put it on the 11th, took it off on the 12th. The next one, put it on the 13th. It's the exact same strategy. This one's only a 250 wide, paid $1.08. The very next day, closed it for $1.51. When all else fails, go back and do the exact same thing again and again and again. Why? Because it's consistency. It's what I started with tonight. By the way, all the trades that I'm showing you here, I tried to pick trades, not only that are recent, I tried to pick trades out of my account in the midst of the heaviest volatility, again, that we've seen in years. Here's another one in Microsoft, okay? Here's another one in Microsoft, and how easy was it? The market was tanking. What did I do? I just used puts. I got bearish. Like that was my directional bias. What's going on? We're tanking. Okay, let's get bearish. Sounds good enough to me. Paid 91 cents, closed it for what? $1.23. That was 2 days, okay? How about this one? Amazon. Woo, the most feared product. Amazon really does, it should kind of send shivers down the spine. Exact same days with heavy volatility. Take a look. $1.15 out with $1.60 credit, right? It just keeps going and going. Again, I can go through example over example over example, but I wanted to give you stuff that was recent, really recent, and I wanted to give you stuff, okay, that was in the midst of, again, pretty much all hell breaking loose in the markets. Go back and look at the days in the marketplace over here, right? This is not a time that you want to fool around with the wrong strategy. Do the wrong thing, take the wrong step, you're going to lose fingers. But you got to understand, there's characteristics of in-out spreads. The attributes of these high probability trades, they're undeniable. You never have to buy the stock. You define your risk. Risk is limited to precisely your comfort level. You don't need to use a stop order. You can vary the time frames and not pay more. I didn't even show you that tonight. All right? You can go out there. You can do this trade for 3 days. Okay? You can do this trade for 3 months. Why not? Okay? And it won't cost you more to do more time. Everybody thinks, because I buy options, it costs me more for more time. You can actually counteract. If you know how to build this strategy correctly, you can counteract time decay. The probability of profit is extremely high. Again, the probability of profit in these trades is high because you're not going to get stopped out. You can hold it through thick and thin. It's the perfect spread to reduce risk of a stock portfolio, and it's an excellent tool if you're going to build returns in a smaller account. Maybe you don't have the capital to go put up for the stock. There's nothing wrong with trading stock, okay? Except when things are really volatile, I'd rather trade the in-out spread. But building the in-out spread, one thing that people always do is they're like, it's options. Don't let options intimidate you. The spread below, and again, I took the SPX spread. And you know why I use the SPX spread? I thought about this, when I was kind of building this, a couple of these slides. I picked this SPX spread because it's a $2,600 plus product, and you only have $2.15 at risk on a per share basis. Okay, the max risk in this trade would be $215. $215. That's it. Okay, but a spread, it's akin to a massive power saw. And I try to make this clear. If you're going to build a house, you'd probably want to use a power saw, not some hand saw. and used correctly, and this is the best analogy I can think of for a spread, but used correctly, using that power saw is going to be the fastest, the cleanest, the easiest way to be able to build that house. Used ineffectively, you're going to cut off a couple of fingers. That's the key in these in-out spreads. Okay, is what? Well, okay, fear not the in-out spread. Again, you have little or no options experience. That's fine. Don't let options intimidate you. Okay, you need these strategies for the foreseeable volatility of a market future. Now, we can show you how and when to place in-out spreads. It's a matter of a couple of hours. And if you don't know options, that's a matter of a few additional hours. Like people, you have to put in a little bit of work. What we do here at TheoTrade is we create detailed trading recipes for every strategy, okay? Including, of course, the in-out spread. And it's like baking a cake. You wouldn't bake a cake without a recipe. Why would you trade without one? But this is what you need to know to successfully enter and exit in-out spreads. All right? This is like getting down to the nuts and bolts. Here's what you need, okay? What makes a viable in-out spread candidate? What does that mean? Should I use the SPX? Yes, you could use the SPX. I could use the spiders. What about the VIX? Maybe the VIX, okay? What else could I use? Could I use Apple? Clearly, I just did an Apple trade. I did a McDonald's. I can go through and I can tell you precisely what's going to be a viable candidate. But in determining viability for a candidate, guess what? You have to know what volatility you should be able to seek out. Then you have to know what options expiration do I select. Even though I said you could do one for 3 days and 3 weeks, we will actually hone in on precisely what options expiration will give you the highest probability of profitability. Okay? And that is very, very definitive. Okay? Then, what should be the delta of the option I buy? Oh, yeah, we have to hone in on that. You can't be splitting hairs. You have to be spot on if you want this to work. Spot on. Because the mathematics of trading doesn't lie. You screw this up, okay? And again, you're going to have a strategy that isn't going to work over a number of occurrences. What option strategies do I sell? Because you have to buy one, sell one, right? How do I build the trade? I'll actually show you structurally how to build the trade. What's the right amount of risk for me, especially in the midst of this volatility? That's dynamic. Everybody's going to be a little bit unique. And this is what we do at TheoTrade. What? Recipes. It's criteria, okay? We actually build a recipe that says step 1, step 2. I mean, trading, it really comes down to answering the what ifs. What might be a good stock or ETF candidate for in-out spread, the correct options expiration cycle, how much capital do I commit, which strike price options do I buy, how many do I sell? Okay, we have the answer to all of these questions. We just build definitive criteria and recipes and checklists for each and every strategy, all the unique variables you're going to encounter. Like, what are some of the unique variables? I don't know. What if the stock goes up? What if the stock goes down? If the stock stays flat? All right, here. We'll answer the questions. What's the right probability? How many option contracts for my account size? When do I close the spread? What if the stock sells off big? What's the correct return for the strategy? By the way, this is probably the single most important thing on the strategy. You have to hit the correct return. If you miss that, dead. Okay? What if the stock rallies massively? Can I fix a losing trade? Can I roll this thing out? We answer the how, the when, the why, at what price. It's just the beginning, though, of the variables you're going to face. Imagine that, though. We literally go through every variable. If it goes up, if it goes down, if it stays flat, if we're coming towards expiration, okay? That's what, okay, an in-out spread is really about. Because the secret, it's really in the sauce. A lot of people, I can read about these spreads. You can Google right now what an in-out spread is. 1,000 different sites will probably come up. It's going to tell you what the spread is, but it's not going to tell you is the corresponding criteria, because that requires the utmost attention to detail. That's what you won't find. We spent years fine-tuning this stuff. Okay, the trade setup, the criteria, how to approach, the entire spread. And when you get to the section regarding criteria, you'll follow the steps to build a trade. Okay, here's class that we have done, in-out spread, and this is the course curriculum. We teach you to construct in-out spreads. In-out spreads are, again, this is a trade used daily by professionals, not just for consistent returns, but to mitigate risk, especially in volatility. How to buy long duration options without paying more, so you can give yourself the gift of time. So if you do want to go out 2-3 months, you can do that without having to pay more. How to use defined risk, okay, versus reward strategies to never, okay, have to lose sleep over your positions again. If you know you can lose $1 and that's the max risk over there, sleep well knowing that in-out spreads are used in any market condition, but are especially viable in more volatility. We're actually going to teach you to build your own in-out spread with detailed step-by-step entry and exit criteria. We're also going to teach you how to do what's called set and forget order types. It's just good till canceled. There's nothing too fancy about it, but we're going to show you how to enter and exit this trade without necessarily having to watch, okay, each and every second. You could put the trade on. You could actually, technically, you could put this on in the off hours, execute the trade, and then set what's called a GTC, good till canceled, to get you out if you cannot watch during the day. It's probably one of the more hands-off strategies that you can employ. In-out spreads are easy to learn, okay, and how to actually place them, again, is even easier. It's one of the most, okay, I would say straightforward strategies, but at the exact same time, people always ask me, they're like, well, what's your go-to strategy? I always turn it to the in-out spread. My account's filled with them. If you have an account, $2,000 or more, you can trade in-out spreads. They could be done in retirement accounts, minimal options experience, smaller accounts looking for large upside potential. This is the high probability in-out spread course. I happen to be the trade instructor for this one. It's a 3-hour course. It's available immediately. It's already, okay, ready. It's available immediately, 24/7 access. We even have mobile access. Some people are like, I can't sit in front of my computer. That's fine. TheoTrade has a mobile application, okay? You could be flying tomorrow. You could download the course, okay, watch it on the airplane. I think after you download the course, just like Netflix, we give you 3 days to watch it. But again, you could stream it and stream it and stream it. The class slide deck that includes the entry and exit criteria, the checklist, is available immediately for download. The class also qualifies you for reduced commissions rate. It's $199. Today, we have a nice offer on this class because we feel that everybody that comes out, okay, and checks stuff out here at TheoTrade, you've been there and you've done that, okay? And again, how many people have actually been to some other session, they belong to another education firm? Everybody's been there, done that, okay? You've been through the gauntlet of paid classes and indicators and what I call secret squirrel black boxes and more. I hate that stuff. I just can't, follow the bouncing ball. If when it's 3 red, arrows, you must get out. When it's 3 green arrows, you have to buy, only to find you just have to buy this one last thing to make all the difference. But wait, there's more. People get strung along for years, paying for just garbage indicators, sales pitches, educational garbage. And we intend here at TheoTrade to put an end to that. What do we intend to do? Really disrupt financial education. TheoTrade is built by professional traders. Everybody here has got a minimum of 15 years of experience. We don't have any professional salespeople. We do not have any salespeople on the crew. Okay, everybody here worked as a market maker, a couple of hedge fund managers. Okay, that's it. Educating you. It's our only goal, and we demonstrate it, and I'm going to demonstrate it right now. Hopefully, this forever changes the way that you personally view education, because I'm going to introduce you to TotalTheo Unlimited Streaming Monthly Membership. What's that? Well, here it is. It's TotalTheo Unlimited, only $99 a month. What do we do for it? Okay, well, what do we do? Okay, it's the high probability in-out spread course. It's included in TotalTheo Unlimited Monthly Membership. In addition to that, we have 79, that's right, 79 trading classes, all available immediately. They're on demand. We have new monthly classes. It's $99 a month, and you just have access to what? To 79 classes. But the class that I want you to watch the high probability in-out spreads course. That's why I'm doing this presentation this evening, because this is what's in play right here, right now. Got to do the in-out spreads course first. But we also have new monthly classes. We also have a chat room. We're broadcasting a minimum of about 6 hours per day. About 6 hours a day. Tomorrow, it's actually a 7-hour trading day tomorrow. We even do a happy hour tomorrow. We also provide you indicators, the 59 proprietary indicators and scans, 59 of them. We email out trade ideas, right? We also happen to have right now 4 separate portfolios that you can follow. You're like, I don't want to do my own trades. Well, we have 4 portfolios you can follow. I'll show you them in a minute. We have daily coaching sessions with timely topics and stocks, options, futures. And we answer, okay, all of your trading questions via email or in our chat room. Okay, it's TheoTrade.com/all. People are, it's $99 a month. That's not an introductory price. It's $99 a month, period. Do you have to sign up for a year? No, you can sign up for $99 a month. Can I cancel anytime? Yes, it's $99 a month. Okay, can I just buy the class? Yeah, but it's $99 a month. It's a lot easier to do this way. Okay, a little bit about whatever our members are saying. Okay, by the way, you guys are rocking it. Very impressed. It's really refreshing to have you guys putting this together and sharing knowledge and not upselling everything and turning and burning your customer base. You got a customer for life in me because of this approach. And I'm sure, okay, I'm not the only one. It's from David. Okay, here's another one. I'm very impressed with TheoTrade. I've studied under stock coaches, various, strategy, intellects, and different trading plans. I have not come across anything as good as what I'm seeing here. The people at TheoTrade are very helpful and extremely knowledgeable. I look forward to this association for years to come. You can go out and just purchase the high probability in-out spreads course. We will sell it to you for $199. People go, what? Okay, yeah, you have to pay $199 for the course. Or you can sign up for TotalTheo. It's unlimited streaming. It's the Netflix of this business. Okay, and I'm going to show you, what do you mean there's 79 classes? There's 79 classes. The average class, okay, is about 3 hours. We do have a couple classes, though, that are substantially longer than that. Okay, there's more than you could probably ever watch, but you're going to pick a genre of trading. If you want to trade options, I'm probably your guy. If you want to trade futures, you're probably going to cruise over to Tony Rago. If you want to know technical analysis charts better than anybody, you're going to go to Jeff Bierman or maybe Slim Miller, okay, or maybe Corey Rosenblum, okay? Better yet, you want to go to fundamentals, okay? If you're into fundamentals, got just the guy for you, Brandon Chapman. We have something for everybody here, and that's what we're trying to effectively create. So you don't have to go out and spend, hundreds and hundreds of dollars. Do you realize that one class, okay, that you buy at another place, it's $500, maybe $1,000 per class. We'll give you all 79 classes. You're like, I'm going to binge watch this stuff in a month. Well, we hope that you're going to stay for longer than a month. That's why we do it at $99 per month. I mean, if you want to pay a one-time fee of $199, we're fine with that. We'd rather give you $100. Why do I say we're giving you $100? Because we'd rather you signed up for $99 a month because we're sure that you're going to like this so much that you're going to stay for more than a month. Okay, and that's the idea, obviously, behind TheoTrade. So I'm going to take you into a little bit of TheoTrade. I'm going to answer a couple of questions because there's always questions that come up on this particular front. When I say I'm going to take you into TheoTrade, well, here's the site. This is what the site happens to look like. And again, each and every one of you can come in here and you can log onto the site and log onto the site, sign up, and we'll give you the email, password, everything. Log onto the site. You can be in here tomorrow. This is actually where we stream live throughout the course of the day. It's a video player, okay? This is the chat room. Look, people are talking in here, right? There are hundreds and hundreds of people. In fact, we currently are over now 3,000 full-time members in here. 3,000 members now to TheoTrade. The next thing I want to show you, so this is what the chat room happens to look like. Again, we just stream in here and we stream at 720p. I have it all blown up right now. It looks a little cleaner maybe during the trading session. The next thing, this is actually the TheoTrade classes archive. This is where you'll find 79 different classes. Find your genre. Are you an options strategist person? Are you a newbie? Because if you're brand new to this stuff, you're like, I don't know where to go. If you don't know where to go, guess what? We have a tab called Start Here. You know what Start Here means? It means Start Here. Options 101, Options 201, Options 301. This alone, okay, is worth way more. Look at this. Order execution, part 1, 2, and 3. Crash course on Greeks. But somebody may say, well, I'm just not into options. Cool. Day trading classes, technical analysis classes. Let's see, technical analysis, that archive happens to look like. Okay. Again, when I say we give you everything for $99, there's nothing else here at TheoTrade. This is everything. You want Fibonacci's, contrarian trading strategies, art and science of trend trading, okay, technical analysis 101, 201, goes on and on and on and on. If you are an options geek, options happens to be our forte. We have several options strategists, okay, on staff over here. Options, ooh, you name it, okay. Oh, the next big short, risk twist spreads, butterflies, in-out spreads. This is your class right here, in-out spreads. Okay, how to collect income being short. This is actually the member home. We have a full searchable archive. You could type in any topic you can dream of in trading, and something will populate in there. Okay, again, as I said, it goes on and on. To enroll this evening, TheoTrade.com/all. Again, it's TheoTrade.com/all. I'll bring that up once again. Again, this has unlimited monthly streaming. There's no, people are like, well, am I going to time out after I watch like 20 or 30 classes? As I said, binge watch it. We designed this thing exactly like Netflix. And as I said, we also have a mobile application. So if you know you're going to be in an airplane, you can actually download classes. Okay, and you can watch those classes. As long as you're a member, you can continue to watch classes. You can watch classes to your heart's content. Okay, that's what it's there for. Coaching sessions, though, every day. As I said, we stream and trade live with you for 6 hours a day. In fact, you know what? One thing I missed, and I do think we should cover this a little bit, the portfolios. There's a duration portfolio, a fruit fly portfolio, a growth small account portfolio, a sell premium portfolio. Okay? Each and every aspect that you can think of. Again, the duration portfolio, it's longer term trades, stuff that people are going to hold. Fruit fly just happens to be a strategy. This one is a lot about butterflies. Here, selling premium, iron condors, vertical spreads. Okay. Yes, we have discounts. Okay, at TD Ameritrade. We have discounts at TD Ameritrade. Okay. We have discounts at E-Trade, of course, as well. There's a multitude of brokerage firms we work with. It's TheoTrade.com/all. If you have an existing account at TD Ameritrade, okay, after enrolling this evening, we can give you instructions to get a discounted commission rate. I am not currently at liberty to mention what the discounted rate is while I am live. You can ask in the chat room, okay, and we can post that in there. Again, if you ever need to get a hold of us after tonight, it's simply support@theotrade.com. Our 800 number is up here. I want you to walk through, okay, and recognize, yes, it's $99. But you're taking this initially to go through the high probability in-out spreads class. Okay? That's, again, in this type of a marketplace, I want you to focus on that. What else do you get? You get everything. For those of you that are into technical indicators, okay, we write our own scripts. Okay? We write our own scripts, and we have dozens and dozens of scripts that we give you from day one. We don't want to hold anything back. We want our clientele to be successful. Why? Because at $99 a month, you'd be a member forever. That's what we, okay, are intent upon doing. So let me answer a few of the questions that have actually come up in here. Again, go to the site, TheoTrade.com/all, enroll for it. Again, you're not going wrong for $99 a month. And if guess what? If you cancel after a month, okay, we'll still go home friends. It's all right. All right. People always ask, is it a membership for $99 a month and can I cancel anytime? Absolutely unequivocally yes. However, you pay a month at a time. Okay. So we ask if you sign up for $99, okay, spend the month. Okay. Binge watch. We believe that you're going to stay more than a month. We've had people, they'll even leave. They always come back. They always come back. Right? Next thing, people said, I have difficulty getting approved for options because I'm brand new. We will help you because these classes, okay, have been run through the brokerage firms. We will help you get approved for options. Okay. Next question, IRA. Can I do these strategies in the IRA? Almost everything that we cover here at TheoTrade can be done inside of an IRA, right? Day trading margin rule. If you're coming against the day trading margin rule, we can even help you, okay, in understanding it and helping you circumnavigate it. If you have a $2,000 account, you can trade in-out spreads, right? People say, I can't make some of the stuff that's recorded. Listen, we broadcast for 6 hours a day. Not everybody, we have 3,000 clients. There's a ton of clients at $99 a month. You got to realize $99 a month. There's a ton of services out there that charge $300 a month, $300 a month just for their chat room. Then they charge you $500 for a class, $1,000 for this, okay? I know you can't watch everything, but everything is recorded. Every nuance of every single day is recorded, okay, and archived. It's all archived. If you want to watch it later on, fantastic. I do approximately an hour a day. Early in the week, I usually do about 90 minutes. So I kick off each and every day. If you want, come into the chat room tomorrow morning. We'll give you an in-out spread. I mean, that's, again, it's what we do. So if you can't make stuff live, okay, we get it. Huge amount of our client base, okay, they work for a living. So what do? They watch the recordings out there, right? If you work full time, you can still do this. You can even look on your mobile device. As I said, we have a full mobile application for both Android and in the Apple App Store, right? There's no additional cost for the mobile application. Why do we do that? Because we want you to have access to the archives, right? If you're brand new to this, fantastic. We have an entire Start Here section. All of it, okay, again, is included. It's $99 a month. If you have questions, okay, after enrolling this evening, feel free. Shoot us an email, support@theotrade.com. Again, address it to me. I'll also be kicking off the chat room tomorrow. Again, theotrade.com/all. You will be, okay, shocked, maybe a little overwhelmed and impressed with the amount of knowledge and detail that we put into each and every course, okay, and the depth of our archives. Thanks, everybody, for joining us here at TheoTrade this evening. Hope to see you in the chat room bright and early tomorrow. If you can't make it, again, feel free to chat into us or email us, support@theotrade.com. You can even talk to us live right now if you have questions about enrolling. Just click Add to Cart. It's $99 a month. Thanks, everybody. Have a great evening. Bye-bye.